Good morning, everybody. I thought we had Max with us, but Max just decided to leave. Maybe he'll come back. We'll see. I was hoping that Max would extend Thanksgiving regards to all of you, and we both wish you, we all wish you from the Ardeni family a great Thanksgiving up ahead here. Let me see. I got something flashing here. Your default microphone has changed. Microphone. Okay, no, we're good. Again, wishing you all a great Thanksgiving. Here today, we've got a sunny day. Some of my kids have come over, and we're looking forward to a good family Thanksgiving. And in addition to a sunny day, and weather-wise, we have a sunny day in the market. The AI trade is apparently trying to make a comeback here, a pretty good comeback actually. However, NVIDIA has kind of been left behind. NVIDIA is not doing very much. It seems as though Google's leading the way. IBM's also doing pretty well. I guess that's a play on quantum computing. But the risk on is somewhat back on today. Don't see a lot of excitement in the Bitcoin market, not a lot of excitement in the gold market. But hey, we'll take a day like this any day. There's lots to talk about. Clearly, last week was a tough week in the market. We had a significant correction in the not a stock market, not in a stock market correction, but a correction in the AI stocks. And now maybe the market is just going to get a lot more selective about where investors want to take positions on the AI trade. This probably means that maybe the upside on that trade from a PE perspective diminishes, and there'll be more attention to which companies are likely to actually earn something from the AI infrastructure build, and which ones might actually not do so well. So we'll see how that plays out. But it's good to see that risk on is back on, and I think it's justified because it's not just if. I guess what I'm rooting for is for earnings to lead this market up rather than valuation. If you go back to about 6 months after the lockdowns in 2020, the forward PE actually did bounce back up to 22 back then, and now it's still back around 22. Over that period, the stock market, the S&P 500 is up about 100%. And that's just about what forward earnings are up. So it's been a earnings-led melt-up, which is the healthiest and most sustainable kind of melt-up. And I've been thinking that the valuation multiple could be sustainable here around 22, 23, if we're not going to have any recession or recession scares. And what we had last week wasn't really a recession scare. It was a scare that maybe the AI trade is overvalued. Maybe the stock market's overvalued. If the market takes a big dive, maybe that'll hurt the consumer, and that might lead to a recession. So it's kind of reverse engineering. Usually it's recessions and recession scares that cause the market to go down. Now I think we're in a situation where the economy has demonstrated its resilience for so long that people have more confidence in the economy. On the other hand, if the economy breaks, if they're led by the consumer, it'll be because higher income, higher net worth consumers hunker down because suddenly all this money they've been making in the stock market gets diminished. So maybe we had a little rehearsal of that last week, but it doesn't, in my mind, appear to be a very credible scenario. At the same time, we did reconsider our melt-up probability. We had been talking about a melt-up being something like 25% as a subjective probability. 55% is a roaring 2020s. That stays the same. The roaring 2020s is one where the market remains in a bull market through the end of the decade, and we get to 10,000 on the S&P by the end of the decade, the end of 2029. We had been thinking that melt up would be something like a 25% probability. So you put that together, you get 80%, and 20% is kind of a bearish scenario. Whatever bad things can happen would give it 20%. As a result of last week, we thought that maybe the market was less likely to have a melt up. Maybe today we need to reconsider that. But I think after last week, the market's getting a little bit more discriminating and more valuation conscious. You want to give a high multiple to companies, even the hyperscalers that you think are doing it right. So if that's the case, maybe we already have sort of had our melt up, and now we're seeing some correction in that last week, and maybe that's all there is to it. If that's the case, then we're lowering our subjective probability of a melt up from 25% to 15%. And remember, we haven't been rooting for a melt up. We don't consider. We much rather see our base case scenario of a nice leisurely bull market through the rest of the decade without a lot of ups and downs. So if we're taking out 10% from the melt-up scenario, we have to put it somewhere. Maybe I should have put it in the base case, but instead I threw it into the possible worst case scenario. So it's now gone up from 20% to 30%. So we'll stay flexible here, and there's nothing scientific about these subjective probabilities. We're kind of using them as a way to communicate our thoughts about alternative scenarios. With that, let's talk about some of the data that's relevant on a short-term basis to the market. So we'll look at the quick takes, and let's look at some of the charts that are relevant to what we covered in the morning briefing. Oh, by the way, I should point out I'm going to be speaking at the Money Show down in Sarasota on Mondays, and exactly at this time. So I'm not going to be able to do this webinar at 11. I'll let you know. I may do a taping, or I may do a Tuesday live. We'll see how things unfold here. Let's look at some of the charts. Let's go here and share. And I guess this is it. Yep, looks like it. Okay, we're good. All right, so here we go. We've been monitoring the S&P 500 relative to the 10-year average on a year-to-date basis, and you can see that the markets over the past 10 years has had a nice rhythm to it. It's been basically, on average, been to the upside, a little kind of nothing move at the beginning of the year. Then we kind of crawl up in March, April, May, June, July. Then we have sort of the summer things kind of flatten out. Then we get the September sell-off. Then that was followed by a nice recovery going into the end of the year. And so November, December tend to be good months. September tends to be a bad month. We're in November now. November, December's have had a tendency to add a couple of percentage points to the return of the S&P 500. Well, how does this year compare? Obviously, more volatile relative to the average. Obviously, within the average, there's volatile years. So we took a big downdraft here going into Liberation Day. That was April 1st, and then we went to on April 8th, the market made a low as a result of the Liberation Day talk. And then what? Then on April 9th, President Trump said, well, maybe we'll postpone some of these Liberation Day reciprocal tariffs. And the market took off with some volatility, but really never looked back. Then crossed its historical average or 10-year average, went on to new heights. And I guess I should have declared mission accomplished right here, because right here we were about 100 points away from 7,000 on the S&P 500. So maybe we got there ahead of schedule. But the year isn't over, and maybe I got a little too cautious with what happened last week in terms of dropping the probabilities of a melt up. I guess maybe it's, you never know in this market, anything's possible. But we went kind of back down to the average, and now we'll see how it plays out. Here's the same thing for the NASDAQ, same story, except obviously you get a better return on average over the past 10 years if you compare the two. When you have a chance to have a look at them more carefully, if you like. This is the valuation story. The valuation story is we did see the Magnificent Seven valuation multiple get hit by a few percentage points here. That took the S&P 500 down. We also had some valuation multiple reduction in the SMID caps. Remember I said, let me see if I have it here. Yeah, this is the S&P. So here is, oh yeah, I think this was, no, where was it? I'm looking at, oh, there it was, 2020. There's too much going on here, but 2020 was the lockdown recessions. This was the lockdown bear market in 2020. And if you look, you can see that we bounced right back up to something, well, I guess on a daily basis, we jumped up over 25, but it settled around 21 if you look at it over here. And you can see that from here to here, the S&P 500 rose 100 percentage points with a multiple of 22 and 22 over here. Am I looking at the right thing? Yeah. Okay. Let's move on here. So the good news is the earnings story is fabulous. We had 3 quarters now of much better than expected earnings. It's not unusual that analysts lower their numbers going into a quarter, and they certainly did that this time around for the first quarter. The second quarter, they lowered their numbers. This is the growth rate, so their growth rate expectations came down hard. Obviously, the tariff situation rattled them quite a bit. But then in the first quarter, it turned out to be much better than they expected. Instead of, what, about 6%, it was about twice as much. Same thing happened in the second quarter. They lowered their numbers to under 4%, and it came in at around 10%. And now this time around, okay, they got it. The tariffs aren't going to be causing as much damage to earnings. So as we got into the third quarter earnings season, as we got towards it, they did not cut their numbers very much. And this time around, they were looking for something a little bit better, around 6%. And once again, we beat that with 14%. The problem is that over the past few weeks, there's been some questioning of the quality of the earnings, especially from the hyperscalers and the whole depreciation argument. And I've basically taken a positive stance on that, but honestly, I think we all have to admit it's a known unknown. We don't know how long the GPUs that NVIDIA is selling last. Is it 3 years? Is it 6 years? Do they burn out? Will they be replaced by much better chips that are much cheaper, require less power? All those are known unknowns. But the AI phenomenon is continuing. Money continue to be spent on all that. It's not a perfect technology. It's still got some issues. But Google just came out with Gemini 3, which apparently suffers from fewer hallucinations. So we're making progress. This is a fairly new technology, and I'll tell you, as I've said before, I use it every single day. I use Copilot, I use Gemini, I use Claude, I use all of them. I kind of flip among them. I'm trying to assess which one I feel more comfortable with. But all in all, I still haven't concluded which is the winner. But maybe I never will. Maybe they'll constantly be upgrading them. Um, and all I can tell you is I'm not paying a lot to use these technologies, but I am using somebody's Google Cloud, somebody's cloud, in order to do all this computing. Anyways, here's forward earnings, all-time record high. We thought forward earnings will get to 300 by the end of the year, which a year ago looked delusional and wildly optimistic. But actually, that turned out to be a little bit low. It looks like the forward earnings are already shooting up over $300 per share. The 2026 number keeps going up. As I've said before, the 2025 number matters less and less because the forward earnings, the market is looking forward by 12 months, 52 weeks. Analysts don't do it that way. They look at quarterly and annual. So there's this shortcut for getting forward earnings on a weekly basis, and that is taking the time-weighted average of the current year estimates and the coming year estimate, and using that in PE times E, and forecasting the forecast. What are forward earnings going to be like? So we were forecasting the forward earnings will get to $300 a share by the end of the year. If you put a 22 multiple on that, that gets you to 6,600, which is basically where we are now. You goose up the multiple a little bit, you get better earnings, and there's still a chance for getting 7,000. But hey, let's not quibble here. If we don't get there by the end of the year, we'll get there by early next year, and we're still using 7,700, which would be a 10% increase from 7,000, and would be the third year in a row of double-digit gains in the market. So that would be a pretty nice scenario. There's been a lot of not a lot, but I've been seeing people saying that, well, this has all been a Magnificent Seven market led by the earnings of the Magnificent Seven, and that the 493 haven't had any earnings growth. That's just not true. Joe Abbott, who does outstanding work for us in slicing and dicing all the forward earnings data and lots of other data, has put together this chart, which shows that the S&P 500, in total, the forward earnings have in fact shot up to a record high, as we just noted before. So this chart here, we were looking at on a very short-term basis, 2022, and we showed you how we calculate forward earnings. This gives you a little bit more history on forward earnings. And but by the way, this is in billions of dollars. In order to strip out what the 493 are doing versus the Magnificent Seven, Joe had to do it in billions of dollars. And in billions of dollars, you can see that the earnings of the 493, we like to call them the impressive 493, they'd be a lot more impressive if they didn't need to be compared to the Magnificent Seven. But if there weren't the Magnificent Seven, this would still be a very bullish earnings story. Not so bullish still is the forward earnings of the mid caps. So here we have the small caps. Here we have the mid caps. Slight upward trend here. Not so much here. Maybe this is the beginning of something, but the problem with the mid caps is the good quality ones, the ones that with the most upward, with the greatest prospects for becoming the next mega cap stock. Well, they get bought out by the mega caps, by the hyperscalers, by the Magnificent Seven, by the larger cap companies before they can really hit a home run for mid-cap portfolio managers. Sad but true. Meanwhile, on the economic front, we now have three. I guess today we actually got the Dallas Fed data, so we'll incorporate that. But the New York, Philly, and Kansas City Fed data show that there's a possibility here that the Purchasing Managers Index for manufacturing will tick up above 50. Not earth shaking, but be nice for a change. Meanwhile, talking about the Fed is got a big debate. There's a lot of dissension at the Fed. Some are ready to cut in December 10th. Others are not so ready. On the not so ready, inflation expectations still remain fairly elevated. We're not big fans of the consumer sentiment survey, but the inflation data seems to be expectation seems to relatively make sense, whereas the other data makes very little sense. So the S&P sectors last week that did well: communication services, healthcare. Healthcare is starting to pop up. Everybody, I think, is starting to look for someplace different than technology, communication services, industrials, and financials. Those have been our overweights, and we're actually going to market weight on technology and communication services, mostly because it's getting harder and harder to recommend overweighting sectors that are remarkably overweight already. And of course, a lot of managed accounts can't go overweight in a handful of stocks. There's, a lot of us are constrained to no more than 2 to 3% of a portfolio can be in one stock. So as it is, it's a challenge to try to stay ahead of the market when just a handful of stocks are doing well. But we're offering you the prospect that maybe in 2026 we'll start to see the impressive 493 performing better, or at least won't be left in the dust by the Magnificent Seven. So you can look at this on your own. We printed out a table of what did well and didn't do well last week, and it's pretty obvious that consumer staples and healthcare did quite well in that environment. Emerging markets and other overseas markets got hit last week on this risk-off trade, but again, looking in 2026, we're kind of mellowing out on the go global versus stay home. We're willing to concede that this was a good year for going global, and maybe that could continue for a while going into 2026. We updated the Roaring 2020s thoughts we have in the morning briefing. As I previously discussed, we've had a number of shocks to the economy, and yet it's remained resilient. We had the pandemic, we had the lockdown, we had the social distancing. Then that was followed by Russia invading Ukraine. We had a spike in inflation, the Fed tightened tariffs, and yet here we are with real GDP at an all-time record high. Here we are with real consumption per household at an all-time record high. If it wasn't for the distortions here, real disposable income is at an all-time record high. We've got corporate profits, all-time record high. We've got capital spending, all-time record high. Stock market, all-time record high. Not too bad, not too shabby, given all these shocks. The resilience of the economy, the stock market have been phenomenal. Very consistent happily, very consistent with our Roaring 2020 scenario. The Roaring 2020 scenario was predicated on the notion that skilled labor, the labor that we need to operate this economy, would become increasingly scarce. Some of that was based on the idea that the baby boomers are retiring, and that the younger generations aren't as big, and as the baby boomers retire, they're being replaced by younger people who aren't as experienced, and we need experienced people, and if we can't do that, then we need to augment the skills of our workers with technological tools that'll increase their productivity. And so it's very much a productivity story, as was the 1920s. And 1920s, a lot of it was about brawn, increasing the productivity of muscle power, of physical exertion, and replacing it with machines and so on. This is more a revolution of the brain technologies, which I listed in the morning briefing. But on a 3-year basis, this productivity can be awfully volatile. We had a big productivity boom in the 90s. There was a big productivity boom in the 60s, and you can see that these booms can really get going. They can be 3 to 4%. And so we have recovered to 2%, which is the historical average. We think it's going to 3 to 4% over the rest of the decade, and that is a huge story if in fact it unfolds. It would mean that real GDP would be better. Right now, real GDP is 2.1% on a year-over-year basis. The average historically has been 3%. We had a lot better performance of real GDP with some more volatility, of course, back here. Then real GDP growth kind of simmered down over here. But we think that productivity could get us back over the 3% growth rate to 3.5%. And obviously, if we do anything like this, it could get even, I should say, like this or this, we could get even higher with productivity-led growth, assuming that the labor force and employment grow by just 0.5%. Well, just for fun, we extrapolated what the roaring 2020s might entail for the rest of the decade. And so we gave you a projection here of what a roaring 2020 scenario might be for earnings per share for the S&P 500, 268, 310 for this year, then just real simply 350, 400, 450, 500 for 2030. That, of course, would be starting the 1930s decade. Obviously, in that scenario, no recession, maybe rolling recessions along the way. Again, this is our base case. We're not saying there could never be a recession. We could be wrong. We could change our minds. But right now, things are we're roaring with our roaring 2020 scenario. So we'll be watching what analysts are predicting every single week to see how that corresponds. But that's the roaring 2020s. Now, when we do PE times V, we look at forward earnings, and as you can, we do a real simple thing. We take our projection for what is likely to be in each of these years, and say and just assume that the analysts who tend to be optimists, anyways, the further their targets are, we just move it one backwards into the years. So right now, at the end of this year, we had been targeting 300 as earnings per share, and we're already there. And that 300 is forward earnings, and forward earnings is what we and the analysts are expecting earnings will be next year. Market discounts looks ahead. So this is the same projection for forward earnings, just lagging those numbers above. This is the actual forward earnings, and this is actual earnings. And again, it's on a ratio scale. Maybe to some of you this looks aggressive, but it is. I mean, it's the roaring 2020s. In terms of the PE, we're taking 18 to 22 as kind of the range. No recession. With no recession, we don't expect the PE to take a dive down to 15 or to single digits. So 18 to 22. Again, we're talking the roaring 2020s here. So put that all together, forward PE times forward E, and we get 7,000 to as the high, 5,400 as the low. Again, 22, 18, and take it all the way up. And in 2029, we get a range of 11,000 to 9,000. Let's split the difference and make it 10,000. And again, this is obviously an optimistic forecast with the valuation multiples staying up, with earnings the assumption has to be that the profit margin is going to go up in a roaring 2020 scenario. I think in the morning briefing, we calculate that if we get to 10,000 compared to where we were, I think we were like 3,300 at the beginning of the decade, that'll give us something like a 220% increase during the decade, which sounds phenomenal. But when you look at decade performances, we've had previous. This was the 1920s, obviously ended badly. We don't think the roaring 2020s will end badly. We've had some clunkers, and then we had another good one here, good one here, good one there. So when we finally put this on, if we're right about 10,000, we'll actually be somewhere around here, which just points out that, you know what? There have been previous roaring decades. It isn't just the 2020s, and it's just not this one. Other decades have had, like, remember that this was pretty roaring in terms of the market return. Well, in the roaring 2020 scenario, inflation comes down, productivity lowers unit labor cost inflation. In the short term, inflation seems to be stuck around 3%. And the reason it would have been probably down to 2.5% by now if it hadn't been for the tariffs, which raised the durable goods inflation rate. But that should start to stabilize and maybe start coming down, especially if the Supreme Court rules that tariffs are unconstitutional. But we'll see how that one works out. Meanwhile, unit labor cost inflation, which is hourly compensation divided by productivity. Unit labor cost inflation is the sort of the core inflation rate in the labor market. So that's running 2.5%. And if productivity grows even faster, and let's say wages continue to rise around 4%, real wages go up and productivity goes up and everything's wonderful. Again, remember I said we're we are lowering our excitement about technology and communication. We're not lowering our excitement about it. We're just kind of, I think, being realistic here, and that pointing out that the market capitalization share of technology and communication services is 45%. That's based on 38% earnings share, and maybe that continues to gobble up the rest of the market. But our thinking is this is in terms of share of capitalization, maybe that'll be it for a while. So it still goes up along with the market, but it doesn't continue to greatly outperform. And again, it's hard to overweight a sector that just is eating up the market the way this is. So where do we go? Well, we're still recommending overweighting financials. We're still recommending overweighting industrials. You can see those are actually relatively small. Financials is somewhat bigger here and has a relatively high PE, but financials make sense to us. Healthcare is sort of new for us. It's relatively cheap. It's been beat up quite hard. I think it's discounted a lot of the bad news. I'm sure you all know the story for and against, but we're more for it now, so we'd be overweight that. And then there's the stay home versus go global, and as I said, we're kind of mellowing out on that issue. We've had a good run here. Maybe we overstayed our welcome here. Maybe it's time to rethink about going global some more. And again, it's hard to just continue to overweight the U.S. when it's already 65%. 65% of an MSCI global portfolio. So I think we're just kind of being realistic about, how much outperformance can continue. Meanwhile, I think this is starting to work for us. We didn't look too bright here with our bullishness on the dollar. We viewed this as a correction. We called it a correction. Looks like it's holding its own so far. And again, the DXY is not very useful because it's 57% the euro. But I think on a trade-weighted basis, the dollar looks even firmer. Gold, I know nothing about gold, yet I have an opinion on it. The only thing I really knew back here when the market crossed 3,000 and we targeted 4,000 by the end of this year, the only thing we knew is that the central banks were buying the gold and that Chinese investors might have gotten so burned in their property investments and the whipsawing around in the stock market that they might be big buyers of gold, and that should continue to be the case. So now we're talking about 5,000 as a target for the end of this year, and then 10,000 by the end of the decade. 10,000 by the end of the decade. The only thing we have going for us to explain that one is if you put the S&P 500 and gold on the same chart, you can see that they tend to be inversely correlated, which makes gold a pretty good diversifier in a S&P portfolio. But the trend is just about the same, and so if the S&P gets to 10,000, maybe the gold will get to 10,000. Doesn't come with a money back guarantee, by the way. I've never been a big fan of Bitcoin. I've kind of stayed away from it. There's people who are absolutely fanatical about Bitcoin. You don't want to upset them too much. But we still think that, the story for Bitcoin now is that it's volatile. It's taken a drop before, and look how it came back dramatically. Well, what's missing is some observations along the way that the reason Bitcoin came back is Wall Street decided to support it with ETFs. Why not? If we can make money. So, Wall Street's attitude is we're going to make money on it, even if we don't believe in it. They didn't believe it for a while, but all of a sudden they're setting up ETFs. And then the Trump administration comes in and they're all crypto all the time. And I think the Genius Act may have topped the Bitcoin market, because when the Genius Act came out, that created stablecoin, and stablecoin takes away the transactions function that Bitcoin was supposed to serve. But something like this, it's hard to imagine that it's a useful medium for transactions, and even as a store of value, it's somewhat questionable. And of course, we're watching Michael Saylor's stock. Michael Saylor got featured in Forbes in January of this year as a Bitcoin alchemist, and so far looked pretty good here earlier this year, I guess. Not so much right now. So I spoke at length here. A lot of things to talk about. Let me, if some of you want to hang on, let me see if I can address a couple of questions here. Lee, two questions. Is the utilization of the bond market for companies to raise capital for data centers, as depicted in today's Wall Street Journal, and the premium they are paying as a result, indicate their own lack of confidence in their viability? I think it's healthy that that there's a lot of questioning about how these things are getting financed, about how they're getting depreciated. I think it's a good thing. I'd like to see some air come out of the AI bubble in the market. That reduces the chances, in my opinion, that the bubble continues to inflate and it bursts. So this is a healthy development. I was asked about this on Bloomberg this morning, and I said, I think this actually means that the market could start to favor the 493 and not just be so focused on the Magnificent Seven, and the market may become more selective in trying to figure out which one of these hyperscalers are going to do it right. Matthew, good morning, Dr. How do you address concerns of increased reliance on the high-end consumer top 10% with respect to economic growth? Thank you. Wishing you and your family a wonderful Thanksgiving. You too, Matthew. Yeah, same story as I've been telling before. The baby boomers are retiring, and they're spending their nest eggs, but they can't seem to spend it fast enough because the market keeps going up. So I think some of the statistics that are being thrown around that 10% of the consumers are doing all the shopping. I mean, that's obviously is wrong. Just go to a Costco and you can see all kinds of people with large families, couples, and they don't all look like they're at the top 10%. Though I don't know what that. I'll retract that. I don't know what rich versus poor people look like. I don't want to. Don't want to say anything about that, but you know what I'm saying. So I think the consumers are still in pretty good shape. And yeah, the unemployment rate just ticked up to 4.4%, but it's 4.4%. It's not 5, 6, 7, 8%. We're not in a consumer recession, and consumers are still spending. Some consumers are spending just on what they absolutely need. Others are spending on a lot of more of what more than they actually need. Jim, can we get the slide deck you used during today's call? Yeah, I mean, it's right there, Jim, in the morning briefing. There's a PDF right at the top of the morning briefing that you can just click on. It's always there. Gary does the 4.5%. Gary, does the 4.5% one-year inflation expectations bother you in regards to your forecast? Happy Thanksgiving. No, it looks to me as though there's a lot of talk about affordability, and I think there's a lot of confusion about the price level versus the inflation rate. And I think a lot of the survey data, particularly the one I just showed, probably reflects the fact that some people just look at prices today and they still remember what they were a few years ago, early on or before the pandemic. And so there is the affordability issue from that perspective. Look, I've seen it myself with my kids' car insurance. It's $4,000 now to insure a young adult. I mean, young adults can't afford that, so I'm helping them. So yeah, there's definitely an affordability issue, but I think car insurance isn't going up the way it had been. Can you review figure 15 again and go over the capitalization ratio? We'll do that next time for you. What are the bull-bear ratios? The bull-bear ratios is investors' intelligence, and it got in the beginning of November, it got over 4, and we said that could mean a pullback, and there has been a pullback. Let's call it a day. Appreciate you joining in, and I'll keep you posted on whether I tape something for next week Monday or we have a live session on Tuesday. Meanwhile, all the best to you and your families, your friends in the holiday season. Right up ahead here, and enjoy Thanksgiving. Bye bye.